prefer stocks over money market funds. That's called consistency. Whenever we use the word consistency, internal consistency, we're really talking about rationality. We're rational. What would not be rational would be something that is not internally consistent. The conclusions that we can reach: utility is unbounded on both sides. What does that mean? That means A can be extremely high, extremely risk averse, or it can even be negative, which, again, for risk seeking, I don't agree with that. I don't agree with that. I think you're risk ignorant, maybe, but I have a hard time with risk seeking. Higher return results in higher utility. Yes, we all want more. Higher risk results in lower utility. The higher the value of A, in other words, the more risk averse you are, the higher the negative effect on utility, which is true. So given one investment and two investors, one with a higher level of A or more risk averse would get less utility out of the same investment that somebody else would get that is more risk tolerant. So just to finish up on the utility function that we have here, we can look at A in terms of three different positions A can take. A can be greater than 0, which implies risk aversion. The greater it is, the more risk averse. A could be 0, implying risk neutrality. Or A can be less than 0, implying risk seeking. And I'm just going to put my word in here, risk ignorance. They just don't know the difference. So let's have a look at some indifference curves. These indifference curves here are for a risk-averse individual. And the indifference curves plots the risk-return trade-off for a given level of utility. So all along this curve is equal utility. It's a trade-off. So to induce us to take on more risk, notice that they're upward sloping, we would have to get a higher return. As we get to a certain level of risk, each extra unit of risk requires us to get even more and more return, which is why they're sort of increasing at an increasing rate, because after a certain point in time, that every little bit of extra risk, we say, well, come on now, that's a little much. I got to be paid a lot more for that. But when we're risk-free, we don't really need to be paid a lot to get a little bit more risk. Notice that it's a small difference on the expected return. It's upward sloping, as I've just said. Higher risk must be accompanied by higher return. It's curved, non-linear, which means increasing slope. Required return increases at an increasing rate. It's also attributed to something called the diminishing marginal utility of wealth, that if I'm getting a certain type of return for a certain type of risk, that's already quite a bit. A little bit more is not going to impress me, which means to take on the next bit of risk, unfortunately, you got to give me even more return because, well, I'm already at this level of return. Another incremental level doesn't impress me. You got to keep going higher and higher. So we can use that argument as well, diminishing marginal utility of wealth. So let's look at varying the level of A right now. So what we have here is we have a very high level of A. So we have an indifference curve, or a utility from the utility function. The indifference curve would slope upwards like this, indicating high risk aversion. Here is someone with more moderate risk aversion. Here would be low risk aversion. The straight line would be risk neutral, and this sloping line would be risk seeking. So we have A going from negative to 0, from 0 slowly going positive. As we go through each of the steeper curves, we're getting A at a higher and higher level. The key assumption that we make in everything we do in portfolio theory is investors are risk averse. Sure. Okay, so you got these people out here that are either risk ignorant or risk seeking, whatever the case is. They're not portfolio managers. I'll tell you that right now. They're not. So we can make the assumption that investors are risk averse. So let's look at how we would rank these 4 different investments. 1, 2, 3, 4. Here's the expected return and the standard deviation of each one. Notice that as the return goes up, so does the standard deviation. Let's look at what somebody with an A of 4 versus somebody with an A of 2 versus somebody with an A of 0 would choose, because it's not really obvious which one you would choose. Would you take the 12% with 30% standard deviation? If you go to 21%, it's more risk, but you're getting more return. Going to 24, again, more return, more risk. At what point does the trade-off not work out for you? So all we're going to do is we're going to use the utility function here that we have, our expected return minus 1/2 A times the variance. And here we just have standard deviation. So if you put in 12% here minus 1/2 A, plug in your 4, and then your 30% here squared, or your 0.3 squared, you will get negative 0.06 for here. Here you'll get negative 0.095. This will give you negative 0.11, and here you get negative 0.165. Which one would a risk-averse investor choose? Well, remember now, we're trying to maximize our utility. That's what we're trying to do. We just figured out what our utility is from each of these. We want to maximize our utility. Well, they're all negative. But this is the least negative, which means that is the greatest number. So if we were risk-averse, we would select investment number 1. But we're risk-averse here. We got a score of 4. Well, what if we're not so risk-averse and we're down to a 2? How would we rank these portfolios now? And again, you just substitute them in. Everything stays the same except the A changes from 4 to 2 with these same numbers. And let's re-rank them again. We'll get 0.03. We'll get 0.0275. Here we'll get 0.05 and 0.0375. We're trying to maximize utility. So we want the largest number because this is what U equals. Well, here it is right here. This is what a risk-averse investor would choose. They would choose investment 3. So, two separate individuals faced with the same utility function but a different risk-averse coefficient. You have 4, I have 2. We would choose different investments. What about A equals 0? Well, if A equals 0, what happens to this term? This whole term becomes 0. So what does this whole column become? It's just a replication of what we have here, 0.12, 0.15, 0.21, 0.24. U equals these. Since we're trying to maximize U, this is the selection that we would take if we were risk neutral. And if we were risk-seeking, again, I don't agree with this, but if we were risk-seeking, we would just say, forget all of that. Give me the greatest amount of risk. There it is right there. I don't want 1 line of cocaine. I want 8 lines of cocaine. That's what I want. I don't know if anybody really does that on purpose. So let's take another step forward here and let's start building a portfolio and seeing if we can sort of develop any kind of framework to start analyzing optimal portfolios, start working towards how we would select an optimal portfolio. So let's begin with 2 assets. We'll begin with a risk-free asset and a risky asset. We'll call that the market. And remember, all assets can be described by 2 characteristics, its return and its risk. So the risk-free return is RF, and the risk, well, it's 0, right? That's why it's called risk-free. So its variance will be 0. Its standard deviation will be 0. The risky asset can be described by its return, which is the expected return on that asset. And its variance, well, we don't know. Let's just say it's greater than 0. We know it's greater than 0. It's not 0, right? There we go. And we'll let W1 be the weight of the risk-free asset. So if W1 is the weight on the risk-free asset, W1 is the weight here, the weighting here must be 1 minus W1 because they must add up to 1. The weights must add up to 1, right? So given all of this, the expected return on the portfolio remains to just a weighted average of the returns on each of the assets. The weighting on the first asset times the risk-free return, plus 1 minus W1, which is the weighting on the second asset, times its expected return. So the return on the portfolio is still just a weighted average of the two assets. The variance of the portfolio is W1 squared times the variance of the first asset squared plus the weighting on the second asset. I forgot my square in there, so let me put that in squared, times the variance of that squared plus 2, the weighting of the first, the weighting of the second, the correlation between the two, and the 2 standard deviations. That's just the general formula for to find the variance. So we can go ahead and plug numbers in here, but that would be a waste of time, and here's why. The variance of the risk-free asset is 0. This term over here is 0. This term over here is 0, which means this whole term is 0, and this whole term would be 0, so all we're left with is what's in here. Therefore, the variance of the portfolio is nothing more than 1 minus W1, the weighting of the risky asset. So that our standard deviation of the portfolio is nothing more than the weighted average of the second asset. So if we had 100% of our money in the risk-free asset, we would have nothing. This would be 1 minus 100. This would be a 0. The portfolio standard deviation would be 0. That's exactly what we show right here. So this right here means W1 equals 100%. I think we can say that without much problem. We're going to put 100% of our money in the risk-free asset, which is weighted as W1. Everything else goes into the risky asset, which would be 0. So we'll have nothing in there, which means our total portfolio standard deviation will be 0. Well, let's go to the other extreme and say we're going to put nothing in the risky asset, 0. We're going to put 0 in the risky asset. Well, 1 minus 0 is 1. So 1 minus 0 is 1, which means the standard deviation of the portfolio is nothing more than the standard deviation of the risky asset, which is up here. This is 1 minus W1 equaling 100 now, because W1 equals 0. So that the portfolio standard deviation will be the standard deviation of the risky asset, and the return will be the expected return of the risky asset. All along here is a trade-off between risk and return. These are different weightings. This is weighting 0 or 100% in the risk-free asset, 0% in the risky asset. This is the other extreme. All along here are portfolios. All along here are portfolios that we can choose that are a trade-off between risk and return based on the weighting we start applying to the risky asset until we're all in on the risky asset. Well, this line has a name. Let's see what it's called. So the name of this line is called the capital allocation line because we can allocate capital to these two assets anywhere along this line. It represents the portfolios available to an investor. So if the variance of the portfolio equals the weighting, just the weighting on the variance of the risky asset, which we already concluded on the last screen because the standard deviation of the risk-free asset is 0, we can isolate 1. We can say we can isolate the weight. W1 equals 1 minus the standard deviation of the portfolio over the standard deviation of the risky asset. There we go. Well, what are we doing this for? Where are we going with this? Let's remember what our return, our expected return on the portfolio was. It was just a weighted average of the returns on the two assets. The W1 times the risk-free rate plus 1 minus W1 times the expected return on the risky asset. Well, we know W1 equals this term here. So what we want to do is substitute this term in for the W1s here and simplify and solve and see what we get. Here's what we're going to get. We're going to get the equation for this line. It's going to tell us what the intercept is. We'll derive the slope of that line, and that slope has a name. Now, I could simply just write the final formula out and say, here it is right here. Here's the formula for this line. Here's what it looks like, and off you go. But you know I like to derive things because if you can do it every step of the way, you'll understand it better. For those that really don't care, you can just scroll through very quickly. That's the beautiful thing about YouTube. You can scroll through a bit quickly and move on. So let's just go ahead and substitute this term in brackets for W1 everywhere we see it, and let's see where we get to. So our expected return on the portfolio will be 1 minus, there we go, RF plus 1 minus, well, now we have to do this here, 1 minus P over 2, and the expected return of 2. Well, I want to simplify this. This is a mess in here, so my next step will be to simplify that. 1 minus. And when I do this, I like to just do one step at a time so I don't lose anybody. 1. So let's simplify in here. 1 minus 1, well, that gets rid of the 1s. Now I have a negative, but I have a minus. 1 minus 1, and then a minus is a plus. And we have a plus outside, so that'll remain positive. 2 times ER2. Well, I can multiply through here because I have a term in the brackets, 2 terms in the brackets, and 1 outside. So I'm going to multiply through here, and I'm going to just jump down here so I don't run out of room. So RF times 1 is RF minus, because I have a minus sign, PRF. Whoops, let's keep that F where it belongs. Over sigma 2 plus, I'm going to write it this way, P, and we have the expected return of 2 over 2. So all I've done is I've just moved this to the top. It's the same thing. But what I've done in doing that is now you can see that I have constant terms on the bottom here. So I can sort of collect them, but I got a mess over here. What I'd like to do is move the negative sign to the other side. So follow me on this. I'm just moving stuff around. RF minus this plus this is the same as RF plus this minus this. So I'm just going to change the order here. I mean, we could have done it a different way, but again, I like to show every step along the way. Over 2 minus 2, P RF over 2. Now we're in a position to collect the terms on the bottom. We'll jump up here, which means we have RF plus, and what's in our numerator? Sigma P, expected return R, minus sigma P RF over sigma 2. Well, we have a common term. So we can take the common term out right now. So we'll have RF plus, let's take the common term out. And what we'll be left with, ER inside minus RF over sigma 2. And then let's finish it off. Let's just neaten it up. So equals the risk-free rate plus, what do we have up here? We have the expected return on the market minus the risk-free rate. I don't need that bracket in there. Minus the risk-free rate over sigma 2 times, we'll just move that to the outside, sigma P. That's the equation of this line. The risk-free rate, right there, there's your intercept. This is the slope of the line. Right here, all of this in here is the slope of the line. So our slope is, what's our numerator? Our numerator is the return on the market minus the risk-free rate. You'll recognize that as the equity risk premium. So it's the equity risk premium, adjusted for risk. Adjusted for risk. Well, what does that mean when we adjust something for risk? That's a Sharpe ratio in there. So it's the risk-free rate plus the Sharpe ratio on the market multiplied by the standard deviation of the portfolio. That is the slope of this line. And this slope has a name. It's called the market price of risk. That is the market price of risk. So what happens in more volatile markets, what do you think happens? The market price of risk increases. If the market price of risk increases, the slope of the line increases. Suddenly, it starts to look like this. So the capital allocation line is not just one line that you draw once and for all and it's done. The capital allocation line can vary depending on the market price of risk. So we always want to keep an eye on volatility. We always want to know what level of risk is the market pricing in, and that will tell us what our capital allocation line is. And at that point, we can agree or disagree with the market in terms of the amount of risk they're pricing in. So that if we see that, well, you know what, they're underpricing risk, the capital allocation line is too flat, we think it should be steeper. it tells us, it sends us a signal that our optimal portfolio would look differently. Well, how do we determine what that optimal portfolio is now? Now that we understand the capital allocation line and what the slope is the market price of risk. I took a long time to get there, but I want you to be able to see that every step along the way was logical. You agreed with every little step I made. And sometimes when we go from a statement like this right to here, there's a matter of, oh, well, now I got to memorize this. What does this mean? How did we get that? But if you can derive it, you don't have to memorize it. Suddenly, it makes perfect sense. I get it now. I know exactly what that is. So yes, I do take a long time. And I know there are lots of videos out there where it just runs right to this final conclusion. And I've watched some of them because I like to see what other people do. And I think, if I were learning this, I'm lost. Right now, I'm just lost because it leaves me wanting. I always like to provide more. If you don't need more, you have the power to skip ahead. But if I give you less, you don't have the power to slow it down because there's nothing in between the lines. So, yes, I took a long time. Anyways, here we go. Let's move on and let's lay some indifferent curves on top of this, and let's see if we can't figure out what the optimal portfolio is, given the combination of the market price of risk and our level of risk aversion. So here we go. Indifference curves plus the capital allocation line. Here are three different indifference curves. Here's our capital allocation line. We know that the slope of the line is the market price of risk. And we see that one indifference curve is just tangent to that line. But we have indifference curves that cross the capital allocation line at different points. One at A, one at B. And then we'll just look, given a given level of risk, we're just going to look at what happens as we move upwards on the indifference curves and see if we can't make some logical statements. Let's start with point N way down here. This is an undesirable place to be. Why? Because we can move up to the capital allocation line. We can afford this, but we can afford to do better. We can move up to the capital allocation line without increasing our risk, but we will increase our return. Move up to get higher return for the same risk. So N, we can say, well, we don't like N. We want to be on the capital allocation line. So N is undesirable. What about L? Well, L is unattainable. L is unattainable. It's way off the capital allocation line, so we can ignore that. We need to be on the line. Well, there are 3 points on the line, A, M, and B. B and A. We should be indifferent between B and A. Why? Because this indifference curve represents all. That's called an indifference curve, right? Every point on this line we are indifferent about. It's a perfect trade-off between risk and return, and we are indifferent. So we're indifferent between A and we're indifferent between B. A has lower return, but it has lower risk. B has higher return, but it has higher risk. So the increase in return is what's necessary to compensate us for that increase in risk. We're indifferent between the two. However, they're on the same line as N. And remember, we said N was undesirable because we can do better by moving up to M. Well, if every point on this curve we're indifferent about, we must be indifferent between A, N, and B. And since M is superior to N, M must be superior to both N and B and A. So we look for the point that is tangent to the capital allocation line. I know that was a long, drawn-out explanation, but we want to get rid of every other point. We want to know exactly why we're interested in that point. Now, let's say it's a period of market turmoil in the empire. And the Dark Lord comes along, and all of a sudden the Jedi have to run, and the market risk increases significantly. I got to throw some Star Wars out there somewhere. I saw it finally, loved it better than the last 3 that were put out. But anyways, let's say that the market, the price of risk increases, and suddenly we have. Let's keep the same color here. And let's say that we have a capital allocation line that now does this. Suddenly now what we want to do is we want to move from M to L, because now M is undesirable. We want to move to L. So we need to be aware of what our preferences are as an investor. or if we're managing money in a particular fund, that fund will attract an investor of a certain type of risk profile because the fund states, hey, this is the crazy stuff we do. Then we want to be able to watch also, not just watch the level of risk that we're comfortable with, but also what the market is pricing in. Just because the market prices in a level of risk, we might say, you know what? You're pricing it too cheap. I think there's more risk than what the market sees. And I'm risk averse and I don't like that. So remember, the capital allocation line can move within a band of market price risk. And if you have your indifference curves, notice that no matter where you go, it signifies that you should change your weightings on particular assets. Isn't that nice? So one final thing to do before we go is to actually show two different investors on the capital allocation line here to show the difference between optimal portfolios for different people. Remember, we're trying to maximize our utility, and we do this with this function. And since this is negative, this says that we are generally risk averse. However, one person here, A equals 4, is more risk averse than our person over here at A equals 2. A larger A means more risk averse. So if they're more risk averse, they'll be further down on the capital allocation line towards the risk-free rate. Notice that we have a lower return for A equals 4, a lower expected return than A equals 2, but lower risk than A equals 2. We can move up the capital allocation line. We will accept higher risk, but we'll get higher return. This does not belong, this point here does not belong on this indifference curve at all. And this indifference curve would continue on, and as we moved further and further, it would start to get steeper and steeper. So to take this much risk, somebody with an A of 4, you can keep extending this upwards, you can see would have to be compensated with a much higher level of return. We're on to our next learning objective. Actually, we're going to do two at the same time here, E and F, just because they're hard to tear apart. E has keywords of calculate and interpret, and we're calculating and interpreting portfolio standard deviation. And we've already taken quite a few steps towards that. F has keyword describe. Describe the effect on a portfolio's risk of investing in assets that are less than perfectly correlated. And it's that last word, correlation, that really makes up the heart of learning objectives E and F here. So let's just review what we know. To derive the return on the portfolio, we know it's a weighted average of the returns of the individual assets within the portfolio. This is just for two assets, but it generalizes to n assets. You just keep adding up the weights and the returns on each particular asset. The variance is this formula here, which we've seen before, and I'm going to draw your attention to the covariance. And again, this generalizes to n assets. There'd be n terms that look like this, and then for every crosswise pair, there'd be a covariance. So we have 2W1, W2, the covariance of R1, R2, and we know that covariance R1, R2 can be expressed as a function of the correlation between the two assets. And there we go. That's the variable that we're interested in. So let's get that in there. If we take out covariance R1, R2, we can replace it with this expression. And we know that correlation, runs from positive 1 to negative 1. So it is the correlation that determines the effect on a portfolio's risk when two assets are combined. It is the correlation that determines that. So what we want to do to demonstrate that point is we're going to walk through an exercise where we set two assets together in a portfolio with a correlation of 1, and we slowly walk that down to 0 and then walk it to negative 1. And let's see what happens to the portfolio standard deviation. Notice, before we even get into that the return on the portfolio is independent of the correlation. Which means as we change the correlation between these two assets, it should not affect portfolio return. So we're not even going to look at portfolio return. We're just going to really look at the effect on the portfolio standard deviation. So let's start with the correlation equal to 1. So the whole expression for variance, which includes the correlation term, if the correlation is 1, this just drops right out completely and just stays as 1. Notice that it just drops out in this equation here. Well, this can be simplified as a square. And if you multiplied this out, you would get this term. And since we're looking for standard deviation, and this is the variance, if the variance equals this squared, just cancel the squares. You'll have the standard deviation equaling this term. This is just a weighted, all we're doing is we're weighting the standard deviations of each of the assets by its weighting in the portfolio to get the portfolio risk. That's it. So let's move on now and look at correlations that are less than 1. And we're primarily interested in just the third term in the portfolio variance formula that we had on the previous screen, just the third term, where we actually have the variable of correlation in the term. When it equals 1, notice that it drops out. When it's less than 1, it's in there. But what I think we can say quite clearly is that the third term, where a correlation is less than 1, will be smaller than the third term where the correlation equals 1. Regardless of what the correlation is, the first term, you remember the first term was W1 squared plus W2 squared. Notice that this has nothing to do with correlation. So no matter what the correlation is, the first two terms of the variance will be the same. The third term here will be smaller than this third term when the correlation is 1 because this is less than 1. So what can we say? If we know that this ends up being the portfolio variance, it equals the first two terms plus a smaller term than when the correlation is 1, which means when the correlation is less than 1, the portfolio variance must also be smaller than if the correlation were 1. Thus, the standard deviation of the portfolio, when we're dealing with a correlation that's less than 1 between the two assets, will be less than the standard deviation of a portfolio when the correlation between the two assets equals 1. So let's try that out. Let's cycle through a correlation of 1. We'll do a correlation of 0, and then we'll do a correlation of -1, and let's see what we get. Well, we'll start off with our correlation as 1, and we'll calculate the return on the portfolio, and we know it's just a weighted average of the two returns. And these is our scenario here. We have two assets. Both of them will return 10%. Both of them have standard deviation of 20%, and we have a weighting of 50% on W1, which means 1 minus W1 must also be 50%. 0.5 times, what's our return? 10 plus 0.5 is our weight. What's our return? 10 equals 10%. That would have been easy to figure out. And we're going to see as we cycle through the correlations that this simply does not change. All we're concerned about now with diversification is reducing our risk. Let's look at what the standard deviation of the portfolio would be. So what do we have? We have the weight of the first one squared multiplied by the standard deviation of the first asset squared plus the weight of the second asset squared multiplied by the standard deviation squared plus 2 times the first weight times the second weight times the correlation times the standard deviation of the first asset. I'm writing standard deviation. Standard deviation times the standard deviation of the second asset. So the first two terms come to 0.02. The last term here comes to 0.02. The whole thing comes to 0.04. So if we want to find the standard deviation of the portfolio, we just take the square root of 0.04, and that will give us 0.20 or 20%. Look at the two assets. They equal 20%. We get 20% with a correlation of 1. Okay, great. That sets up our baseline. Let's change the correlation now to 0. They're uncorrelated. How can we do here? Well, what is the return on the portfolio? Again, trick question, right? We don't even have to calculate it. It will always be 10%. What is the return? So let's do the variance of the portfolio, and then we'll take the square root. Well, it is the if we look at the formula that we've done over here, notice that our 1 in here is our correlation. Here, this will turn to a 0. So this whole third term becomes a 0. So we really are only dealing with the first two terms here. 0.5 squared plus 0.2 times 0.2 squared plus 0.5 squared times 0.2 squared. And we know that that is 0.02. You can do the math on that. You'll see it's 0.02. So the standard deviation is the square root of 0.02, which will equal 0.14 or 14%. 14%. So we have 50% of our portfolio in asset 1, 50% in asset 2. They both have a standard deviation of 20%. Zero correlation. Combining the two brings us down to 14%. The same return, but our risk is lower. It's a less risky portfolio. In other words, we're achieving the same return with lower risk. Let's do this last one over here. Let's take a correlation of -1. What's our return? Our return mathematically stays the same, 10%. Mathematically, it stays the same at 10%. Practically, you have to think about that for a minute. Practically, you have to think about that. If R1 and R2 both have an expected return of 10%, and they're perfectly negatively correlated, which means when one is up, the other is down, then they simply cannot, it simply cannot be. You would get a return of 0 in the real world. In the real world, you would. Mathematically, here you're getting the same return of 10% mathematically inside the model. But I want you to think about two perfectly negatively correlated assets. If one is up 10, the other must be down 10. That's the idea behind negative correlation, which provides a 0 return. So this should make you stop and go, wait a minute now. That doesn't seem to make a lot of sense if they're perfectly negatively correlated, right? Well, let's have a look at the standard deviation, and that might tell us something more here. Let's go ahead and calculate that. So the variance of these, we don't have to recalculate. These are the first two terms. We know they equal 0.02. So all we have to do is recalculate this term, but put a -1 in here. Well, if this is 0.02, and this whole term is 0.02 to equal 0.04, if we make that negative, it would be negative 0.02. So we can just save time, be efficient, and look at what we've already calculated, right? Just like Google, save every search so that we don't have to search again. 0.02 minus 0.02 equals 0. And so the standard deviation, which is the square root of 0, is 0. So this should give you pause at this point. You should look at this and say, well, hang on a second. If we get a risk down to 0, I remember going back to that risk management reading, saying that if we can manage our risk down to 0, don't we also manage our opportunity down to 0? Yes, we do. Are there instances where it makes sense to add two perfectly negative correlated assets? The answer is yes. There are 3 different scenarios that I can think of just off the top of my head where it does make sense to add two assets that are perfectly negatively correlated. And I'm going to explain that to you shortly when we finish up the example we're working on. So let's not throw this one out yet. Let's talk about how it's possible that you can end up with 0 standard deviation but yet still have a return. So let's take what we've done. We've looked at correlations from 1 to 0 to -1, and we'll throw a few more correlations in here. And we'll draw the relationship between these two in terms of their risk profile and the return profile. So asset 1 and asset 2. Asset 1 has a return of 7%, standard deviation of 12%. Asset 2, return of 15%, standard deviation of 25%. So all I did was I went up the vertical till I got to about 7%, and I went across to find 12% down here, and this became asset 1. There's that point for asset 1. For asset 2, it had a 15% return. Move across until we get to 25% on the standard deviation. There is asset 2. And what we're going to do, we're going to plot some points for this relationship. We're going to start with a weighting on asset 1 of 0%, and we're going to slowly walk it up to 100%. So if asset 1 had a weighting of 0%, we'd have 100% in 0.2. This is where we'd be. Our return would be asset 2, 15%. Our risk would be 25. So our portfolio return would be 15. Portfolio standard deviation would be 25. Now let's move W1 to 1%. So 99% of our money is in asset 2. 1% is in asset 1. We slowly start moving down the line. It's a straight line. Until the weighting on 1 is 100%, the weighting on asset 2 is 0%, and asset 1, 7%, 12% standard deviation. That is now the portfolio return and risk. It's on a straight line. The thing you need to notice with this correlation of 1 is that every time we reach for return, we add risk. Every time the risk increases. Every time. So there is no benefit to diversification here because you're not ever reducing risk. You're simply getting higher return, but you're also taking higher risk throughout the whole line between weightings of 0% to 100%. But that begins to change when we relax the correlation from 1 to 0.5 to 0.2 to -1. At 0.5, look what happens here. If we have 100% of our income or our money in the first asset, we're at this point. If we go to 99%, we start moving up along the green line. But look what happens. We're going to start gaining more return before we start gaining more risk. So we go up, we can get the same kind of return, a higher return for slightly less risk up to a point, and then we are back on that relationship of you want more return, you got to take on more risk. But there is some benefit to diversification. Even at a correlation of 0.5, we are getting some benefit to diversification. Go down to 0.2 correlation and go through the same process. All of our money in asset 1. As we start adding some of asset 2, look what happens. We can move up in terms of return, but we're also moving down in terms of risk up to a point, and then after that, you want more return, you get more risk. So we have even more benefit of diversification when we're correlated at 0.2. And as you keep going down 0.1 all the way to 0, and then you start going negative, this is the extreme, -1 correlate. But you can see that the less correlated these assets are, the greater the benefit to diversification. So let's look at this last asset where it's perfectly negatively correlated. So if we have 100% of our money in asset 1, this is where we are. If we start moving towards asset 2, 1% at a time, we start moving backwards on this line. But look at this. We're reducing our risk and increasing our return up to a point, and then after that we're reintroducing risk as we increase our return. So we hit an optimal point here, which is, I have it equal to 0. It's 0.000, the lowest I've been able to get. I haven't quite hit 0 point something, but it's basically 0. And the return is 9.588 if we use a weighting on asset 1 of 0.6764. Go through and solve both the return and the variance for the equations that we had. You'll find that if you use that weighting, this is the results that you'll get. So we end up with a situation where we potentially have no risk and some return. Well, how is that possible? I said that we can think of, or I can think of 3 off the top of my head where that's possible. So let me explain to you how that's done. Number 1, this is not part of the learning objective, by the way. This is just if you're interested. If you're not interested, you can move on. Number one, I'm holding a stock. It's December 1st. I'd like to sell that stock. It's selling for $100. I would like to sell that stock. However, I'd put my capital gain into this tax year. But if I could sell it in January, even January 2nd, I can defer my capital gain for a whole year. So how can I do this? Because right now I'm facing risk. How can I get to zero risk and maintain that return? Well, what I can do is I can sell a very deep in the money call. So let's say I go out to, I'll find the January options, and I'll sell, let's go really deep. I'll sell a $25 call. I'll sell a $25 call. Well, it's $75 in the money, right? So I'm going to get at least $75 for this thing. There I go. I've locked in my price, and I've got a portfolio risk of almost zero. Why? Because I'm long 100 shares at $100. I have 100 deltas. This very deep in the money call is probably going to have 96, 97, 98 deltas associated with it, which means I can get very close to zero deltas. Once I have zero deltas, I have no position. I'm flat, which means I have no standard deviation, no risk at all. Because if the stock drops $1, this is so deep in the money, and if it has a delta of 0.97, it'll drop 97 cents for every dollar. Now, I'm going to get $75 plus a little bit of time value, so I'm going to squeeze some more return out of this stock, and I've sold the call on it. Now, when January comes, either the stock will be over $100. Either way, the stock will get called away from me for $25 because I gave somebody the right to call it away for $25. I got paid at least $75 for that. I get to keep that $75 no matter what, and I'm going to get the $25 when it sells, even if it drops all the way to $50. I got to keep the $75, and I'll still get $25 when it's called away. I still get the $100. There's one way where I can still maintain a return and get my portfolio risk all the way to zero. A second way happened in the dot-com boom, where a bunch of founders that brought their companies public became paper billionaires overnight. And we say paper billionaires because they had restricted stock. Restricted stock, and I've gone through an IPO, and I've had restricted stock for 3 years. You can't sell it. You can't sell it. It has to vest over that 3-year period. Now every 6 months, some of that vesting comes due. But then that's when you sell. It takes 3 years to fully vest before you can actually, start selling your stock. Well, every 6 months you can sell a portion of that stock as it vests. So these guys went public. How did they keep their money? Because if you can imagine, they're holding on to all the stock of this company. They're not diversified at all. They've got extremely high risk. How can they get that down to zero risk? How can they get it down to zero risk? Well, turns out you need a broker to do this. You need an investment banker or a broker who's on side and is not going to charge you a lot of commission to do this. What you do is you go to the broker and you say, I have a 3-year vesting schedule. Here's the timing that everything comes off. My stock is trading in the market now for $200 a share. I'm worth $4 billion. I don't want to give that up at all. So what you'll do is you'll pledge your unvested shares, because it has a vesting schedule. They'll come due at certain points in time. You'll pledge your shares, and that investment banker or that broker will go out and short that many shares in the open market. So what happens is if the shares go up, that's fine. On the vesting date, your shares come available. He takes your shares and delivers them to cover the short. And you got the initial money from the sale. If those shares go down, well, great. When the vesting is done, he'll take your shares, sell them in the open market, and cover off his short position. He still locks in the money he sold at the higher amount. That's called a boxed trade. In Canada, you can't do that. That's illegal. I think even what I just described in the U.S. is probably somewhere offside. But if the broker is doing it, then it's not you shorting the stock against your own shares, thereby achieving you're perfectly negatively correlated at that time. And finally, the third option, this is for income investors, and income investors know this quite well, is what you want to find is you want to find 2 nice dividend-paying stocks. and you want to find them stocks that are as negatively correlated as possible. And why do we want that? Well, let me just kind of draw that out for you here. And let's take stock 1, and let's say you had everything in stock 1. Your portfolio value, as stock 1 rises and falls, your portfolio value rises and falls. Well, let's take stock 2. Well, if you had it all in stock 2, guess what? Your portfolio value rises and falls as well. But if they're perfectly negatively correlated and you're holding both, the value, the capital value of your portfolio stays fairly constant. You have preservation of capital, but this stock pays a dividend, and this stock pays a dividend. So you're getting 2 dividends, and your capital value shows very little variation, which means you can get a standard deviation on a portfolio on an income portfolio that's very, very low by investing in income-producing assets that have negative correlation with each other, so that you have that nice preservation of wealth at all times. So I think we can see quite clearly that when we use the word diversification, correlation is the key to diversification. Diversifying across assets that are perfectly correlated, or correlated at 90% or even 80%, doesn't offer you a lot of diversification. You want to find as many assets as you can that are not directly correlated with each other, correlations of 0. Based on my third example I gave you previously, if you're an income investor, you'd like to find negatively correlated stocks so that your capital value shows very low volatility while you derive income. So how do we achieve diversification? Number 1, invest in a variety of asset classes: stocks versus bonds versus cash versus real assets. And even within stocks, you can say, well, energy versus pharma, or large cap versus small cap. In bonds, corporate versus government bonds. Use index ETFs rather than going into stocks and saying, well, I need 8 or 10 different stocks to diversify. Use an index ETF. It minimizes the costs of diversification, and it is diversified across that asset class. Diversify across countries. Exposure to different industries. For instance, in Canada, we are considered a raw materials provider. So when there's a commodity cycle on the upswing, you want to be invested in Canada. We have minerals, timber, ag products, corn, wheat, soybean, lots of that stuff. And if you look at the TSX, which is our index, 50% of our index is weighted towards energy and financials. So if you need exposure to energy and financials, there's a great way to do it. You can diversify across countries to get exposure to different phases of the business cycle. Number 4, don't own your employer's stock. That's not diversification, that's concentration. Especially the pension plan, as I've already mentioned before. It should not own the sponsor stock. You can also achieve diversification or lower portfolio risk by adding assets if the risk-adjusted return benefits the portfolio. So what is the risk-adjusted return? Well, have a look at what I've done here. Here is this new asset that we want to enter. So the return on the new asset minus the risk-free rate. So what's the numerator? That's just the excess return that this asset provides above the risk-free rate, divided by the standard deviation of that new asset. All we're doing here is we're just saying, well, look, the risk-free rate I can get with no risk. So anything above that, that's the risk, that's the return I'm getting for taking on risk. So I'll divide just that excess return by the risk. That's a Sharpe ratio. And we're doing the same thing here with the portfolio. The return on the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. So it's the Sharpe ratio of the new asset should be greater than the Sharpe ratio of the portfolio multiplied by the correlation between the portfolio and the new asset. So let's say the correlation were 1. This whole term becomes 1. Then this truly, the risk-adjusted return truly has to be greater than the portfolio risk-adjusted return. If the correlation is 0.5, the risk-adjusted return here has to be greater than half of what the portfolio is, and you'll still get diversification benefits. You can buy insurance, and I've already mentioned before, buying put options on the index is is the same as buying insurance. We are now on our last two learning objectives of this reading. LOS G and H, keywords here are describe, interpret, explain. So let's see what we're doing here. G, describe and interpret the minimum variance and efficient frontiers of risky assets and the global minimum variance portfolio. So all we're doing here, there's not a lot of math in here. In fact, there's none. In this learning objective, what we're going to do is take what we've already done and start giving names to things. We're just going to name things, that's all. So we're just looking for terminology here. And once we name them, just what does each thing mean? That's all. H, explain the selection of an optimal portfolio given an investor's utility or risk aversion and the capital allocation line. All right, so let's recall up here we have two assets. This will just set the stage for what we're about to do. We have two assets, asset 1 and asset 2, and they're perfectly correlated, which means that as we move our weighting away from asset 1 towards asset 2, as we slowly add more of asset 2, since they're perfectly correlated, we will get more return, but with more risk at each and every step along the way. Well, that's not what we want. We'd like to get more return for the same or less risk. That's the goal, right? Well, when they're perfectly correlated, you can just basically draw a straight line between the two assets. There's nothing interesting here. Let's move over here and let's make the correlation between two assets, and let's take point C and point D. And let's make the correlation less than 1. Less than 1. I have it written here as less than 0. We just want it less than 1. Let me just correct that on the fly. So it's less than 1. How much less than 1? We don't know. But I've already explained in some earlier videos that the lower you get from 1, the better the effect is. And sometimes you need to be below a certain number for anything interesting to happen. So let's just start at C, and we want to start adding some of D. It won't be a straight line now, but it'll kind of look like this. I've really extended this to really make the point. But as we change the weighting on C towards D, we can increase return and lower risk up to a point. And then at that point, as we move closer towards weighting D heavier, we start adding more risk as we add more return. Well, this point has a name. This line has a name. So let's start naming things so that we know exactly what we're talking about. The entire line, and I'm drawing two arrows because I want to make a point that it's this entire line, is called the minimum variance frontier. Let me write that down. Minimum variance frontier. And to be very specific about this, this contains risky assets only. And in the next reading, we will go a little bit further and say, well, what do we mean risky assets? We'll define the components that make up the minimum variance frontier, the components that make up each of the points on here. But for now, let's just say that this is the minimum variance frontier. In other words, we can't lower at this level of return, we can't do better on variance than here. Sure, we could be out here, but for the same return, we're taking on more risk. What we'd like to do is get the same return that C is offering over here, but with less risk down here. We can't. That's why on this line, it's the minimum variance we're going to get. So that's the minimum variance frontier. Everything inside here is inefficient. Everything outside here is just simply unattainable. So that's the best we can do as far as minimum variance. Now this point, as we move from C to D, this point we get to where we hit the minimum, this point Z has a name as well. It's called the global minimum variance portfolio. There are an infinite number of portfolios along this frontier. You can pick one here, you can pick one here, one here, one here, one here, on and on and on and on. There'll be a point where you cannot get your variance any lower. You cannot increase your return without increasing your risk. That is called the global minimum variance portfolio. Great. Point C, A, D over here, these are minimum variance portfolios for a given return. Z is the global minimum variance portfolio. So let's have a look at something interesting here. As we move from Z to A, we'll earn a specific return, and from A to D, I've spaced it out so that the return, the increment in return is equal. But look what happens here as we move on the variance. As we move from Z to A, the variance will increase by this much, but then to get the same incremental return, look what happens to our variance over here. It increases even more, which means if we want the next incremental return, it'll be significantly more variance as well. So as we move away from the global minimum variance portfolio, we will begin to add return, but we will also add risk at an increasing rate per unit of return that we get. So the further away from this point we get, the riskier and riskier it becomes. The variance really starts to add up. So now, from this point, now keep in mind that any point along here is inefficient. This is called the minimum variance frontier, but let's do something interesting here. Let's look at point C. And let's get the ruler out here. I like this program because it allows me to do this. And notice that we have this level of risk, and we can get a certain level of return for C. However, notice that we can keep the same risk and achieve a higher return at A. So you would never choose point C, because for the same risk, you could construct portfolio A. It has the same risk, so you would do that. Well, you can make that same argument for every point along here up to the global minimum variance portfolio. After that, you cannot do better. So any point below the global minimum is inefficient. This is just a minimum variance frontier. This point, anything under here, is inefficient, which means everything above from point Z to point D. Let's make a point of that. From point Z all the way to D and beyond has a name as well. It is called the Markowitz efficient frontier. That makes sense, right? Because if every point below that point, every point below the global minimum is inefficient because we could do better simply by moving straight up, if this is inefficient, this must be efficient. So let's keep in mind the names that we have. The pathway we take to move from C to D offers us minimum variance. That pathway is called the minimum variance frontier. Where we hit the lowest variance possible, that is called the global minimum variance portfolio. And the part of the minimum variance frontier from the global minimum on up is called the Markowitz efficient frontier. So you have the minimum variance frontier, the global minimum, and the efficient frontier. All right, so let's add a risk-free asset. That's what we're going to do. We're going to add just a risk-free asset. Now, we still have the same minimum variance frontier that we had before. I've labeled point Z as the global minimum, and we know from Z on upwards, we're dealing with an efficient frontier, the Markowitz efficient frontier. So all I've done here is saying, okay, well, we're going to add a risk-free asset. Here's the return on the risk-free asset. If I have to plot the point, remember, this is point A. It has a specific return, but it has risk. Here's the risk-free asset. It has a specific return, but it has no risk. So I just plot the point. Now, if we want to have a combination of portfolios, a risky portfolio and the risk-free asset, we can simply draw a straight line to it. Okay, so there's our risk-free rate. We can make a combination of portfolio A with the risk-free. We could do the same thing with Z, the same thing with P, the same thing with X. Every point along this line, we could draw a line through it. So how do we know which one we want to choose? Well, let's have a look at point A. And we can choose any point at random on point A, and let's do that. Let's say that we're going to be at point A here, and we have a combination of the risky asset and the risk-free asset. Well, for the same risk, here's our risk, we can simply move up to P and have a higher return, because we'll be up here on the return, for the same risk. So again, anything below Z is inefficient. So any line, any portfolio down here below the global minimum connected with the risk-free asset, we can ignore, period. We can just ignore that. Well, let's say we were at Z and we drew a line through Z. We can simply move up from Z straight up and find a combination of the risk-free asset and the risky asset P that offers higher return for the same risk. So in other words, what we want is the steepest line that is just tangent to the efficient part of the curve of the minimum variance portfolio, minimum variance frontier. So we find a point that is just tangent to that. So, and that we call the optimal capital allocation line, because we're going to allocate our capital somewhere along this line. If we don't like risk and we want to be 100% in the risk-free asset, we'll be down here. If we want to add some of the risky asset, well, then we would maybe be over here. If we want to be 100% in the risky asset and not in the risk-free asset, we would be at point P. Point P is a combination, it's all just a linear combination of the two. At point P, we're 100% in the risky asset and 0% in the risk-free asset. So let's have a look at the two lines that we've drawn, the capital allocation line for P and for A. And note, for every point on A, there is a point on P, CALP, with a higher return for the same risk. So even if I took a point over here, I could simply walk straight up and take a point on this curve. If I took a point here, I could do the same thing, walk straight up and take this point. So it is dominated. Every other curve will be dominated by the capital allocation line that is just tangent to the minimum variance frontier on the efficient portion of the frontier. So some things we can note here. P dominates Z. Notice that P gives us a higher return. Sure, we get higher risk, but it dominates Z. Now, that's a curiosity. You're probably looking at that and saying, well, hang on a second now. If I'm going to be 100% in the risk-free asset, why would I not take Z? Why would I not just take Z? Because Z will give me, that's the lowest variance. Here, yeah, I'm getting higher return, but I'm also getting higher risk. I mean, anybody can do that. So if I'm going to be 100%, didn't we agree that we were going to choose Z? Yes, we did, but allow me to show you something. If we choose Z, if we were going to choose Z as our minimum variance portfolio, I would argue that, well, you should just walk right up to the capital allocation line and choose that point, which is some combination of portfolio P and the risk-free asset will give you the same risk as portfolio Z, but notice now that you have a higher return. So that's the power of the capital allocation line, is it can show you where to get to, where the optimal portfolio is to do better than the global minimum. When we combine a risk-free asset, we can move up. Now earlier I said, well, if you have an asset with a specific return and you're trying to get a higher return, you certainly would not combine an asset that has a lower return. You would combine an asset that has a higher return. Well, that's exactly what we're doing. To get a higher return than Z, we're not adding a risk-free asset to Z. We're moving up the curve to P, which has a higher return and higher risk, and we're adding the risk-free asset to that to bring it back down. Do you get that? So we're not adding something to Z to bring it up. We're moving up the efficient frontier to a riskier portfolio P and adding a lower return, zero risk asset to bring it back down to Z. That's all. And now we're getting a return that is lower than P. Remember, we started at P. We add the risk-free asset. We're going to get lower return and lower risk, but that lower risk brings us to a better situation than we could if we just chose Z. So combining a risk-free asset and a riskier portfolio further up the efficient frontier allows us to replicate what we could get with Z as far as variance, but with a higher return. So P dominates Z when we include the risk-free asset. Let's go to P. Y dominates X. Notice that Y is up here X is over here. Now there's a bit of a problem. X is on the efficient frontier. I thought we said everything outside was unattainable. But suddenly Y is attainable? Yes, it is. Y is attainable because it's on the capital allocation line. Some of you are probably saying, hang on a second though, you said P is 100% in the risky asset and 0% in the risk-free asset. So what could this possibly be? From the risk-free rate to just slightly under P. At P, we're 100% in P. Over here, we're 100% in the risk-free rate. Well, what are we doing when we're owning an asset with the risk-free rate? We're lending the government money. And that's the rate we're getting, the risk-free rate. Well, beyond here, what are we doing? We are borrowing at the risk-free rate and investing in the risky asset. So this first part over here is called a lending portfolio. This is your lending portfolio because we're lending money. This part up here is called the borrowing portfolio because now we're borrowing at the risk-free asset to invest in the risky asset. So you can think of this return up here as made up of, again, the two weightings on the asset, but the first weighting is going to be negative because we're borrowing at the risk-free rate, and the second weighting will be greater than 1. So if this were negative 0.5, we would have 1.5 in the risky asset at this. So our weightings can go negative, and that is a borrowing portfolio. Still, we can get to here. If we were going to invest in X, we can combine the risk-free asset and move ourselves up here for the same level of risk, the same risk, to get a higher return. So Y dominates X. It's achieved by leveraging portfolio P. Now, LOSG and LOSH, we're not done. We still have one more point to do on LOSH to show where we would actually finally end up. But LOSG and LOSH is really just introducing some of the terminology and some of the structure on which we will delve deeper in the next reading. So it's not too important to understand the mathematics of this yet. We'll look at it later. I just want you to understand the logic behind this. What are we doing so that there's no confusion about how these lines were developed and what they mean. Remember, we're describing, interpreting, and explaining. There's no calculating in here. We're just describing what we see. All right, let's move on. Okay, so now we're going to introduce investor preference. Right at the very end of what I'm about to do here, we're going to go into LOSH, which is to explain the selection of an optimal portfolio given an investor's utility or risk aversion and the capital allocation line. We're really just going to introduce it. Then I'm going to do an extended example, which really brings it home. So now that we have the language down, let's introduce something called the two-fund separation theorem. And basically this says that all investors, regardless of taste, risk preferences, or wealth, will hold a combination of two portfolios, a risk-free asset and a risky portfolio. Now you may say, well, wait a minute, I've never held a risk-free asset. Yeah, I've held risky portfolios, but I've never held a risky asset. My friends don't. I don't know anyone who has. That can't be right. Well, let's put things in perspective. This is not a two-fund separation fact. It's a two-fund separation theorem. And a theorem just helps us organize our thoughts without too much of the real world seeping in, so that we can see if we continue on with that thought, does it lead anywhere interesting? And sometimes it's easier to eliminate the real world to get to the interesting point, because the interesting point still exists in the real world, but if we let all the clutter of the real world in, we would get lost on our way to the interesting point. That's all we're doing, is we're just parting the river. That's all. And the argument could be that, yes, you are holding the risk-free asset. And you may say, no, I'm not. Look at my portfolio. I have nothing. I'll say, well, I see a weighting of 0 on the risk-free asset. So you are on the capital allocation line. You've just chosen a weighting of 0. Have you ever bought anything on margin? Well, there you go. Now you have a borrowing portfolio, not a lending portfolio. You're borrowing at some rate. Now you may come back and say, but it's not the risk-free rate. And I would answer, then stick around for the next reading, because we're going to see what happens when you cannot borrow at the risk-free rate, but you can still borrow. So all of a sudden, this theorem isn't so crazy anymore, right? All right. So if we take this assumption, if we take this, then we can break down the process of identifying the optimal portfolio into two steps. We can have the investment decision and then the financing decision. And the investment decision just says, hey, just tell me what the optimal risky portfolio is without regard to any investor preference. Just tell me what the optimal risky portfolio is. Great. So we've identified it. We have our capital allocation line, which we know is a linear combination of the risk-free asset and the risky asset. So keep in mind, we've identified this optimal risky portfolio, which is probably somewhere on the Markowitz efficient frontier, either from the global minimum variance point on upwards, anywhere on the efficient part. We already know that if we draw a tangent from the risk-free rate to the efficient part, we will identify the efficient, the optimal risky portfolio. All we're left now is the financing decision. So now I can look at you as an investor and say, are you risk averse or are you very risk tolerant? If you're risk averse, well, you don't want to hold this portfolio. You want to be somewhere further down. Again, a combination of the risk-free asset and the risky asset. So we want to lower, keep in mind your risk is down here. We want to lower your risk maybe to here. Yeah, you're going to take a lower return, but your indifference curve might be tangent here. Somebody else may have an indifference curve that's tangent here, and somebody else may have an indifference curve that's tangent up here. So once I identify the optimal risky portfolio, I know where my risk-free rate is, I draw my capital allocation line, then I say, now where along this line shall I put you? If you're very risk averse, well then obviously I'm going to put you somewhere down here. If you can handle more risk, I may put you closer to here, but still some combination. If you're very risk tolerant, I may say, well, let's not just take the optimal portfolio, let's borrow and leverage the optimal portfolio and get you somewhere further up the capital allocation line. So you can see that every decision we make for an investor can be broken down into two steps. Step number one, let's just identify the optimal risky portfolio. And once we're done that, let's just figure out where along the capital allocation line you belong by drawing your indifference curve. Well, we are going to do a very extensive problem that pretty much takes us all the way through this chapter. We're going to put it all together in one thing. Have a look at what we have up here. We have asset A and asset B. Expected return on each asset, the standard deviation of each asset, and a correlation of 0. We have our first thing we want to do here is solve for this. We want to put 10% in asset 1, which means we're going to put 90% in asset not 1, which is asset B. So 10% in asset A, 90% in asset B. Let's calculate our expected return on the portfolio. And this is just our risky portfolio. Notice that these are just two risky assets. They both have standard deviation. These are two risky assets. So all we're doing is we're combining these two risky assets into a risky portfolio. We'll combine it with a risk-free rate later. I think you see where I'm going with this, but let's just start at the very basics. So what is the expected return here? That's pretty straightforward. We know it's just we take the weighting, 0.1, times the return, 0.2, plus the weighting on the next one, 0.9, times the return on the next one, 0.15, will equal 0.155, or 15.5%. 15.5%. What is the standard deviation of the risky portfolio? It is the square root of, we know it's W1 squared, the variance 1 squared. I encourage you to do this each time, is to write this out every single time. And you know what? After a while, you won't even be thinking about it. It'll just happen on its own. You'll just remember this, and you'll never get lost. The more you repeat it, the better it is. So let's we can fill in the terms at this point. We will get 0.3012 or 30.12%. 30.12%. So if we were going to plot these 2 points on this particular graph, well, let's find where A is. A has a return of 20%, and we can bring our ruler out here. A has a return of 20% and a standard deviation of 50%. So there's the 50%. Here's our 20%. We could draw a line right there. There we go. Let's look at B. B has a return of 15% and a standard deviation of 33. That's roughly about 33. Here's our 15, so we're right there. There we go. So we sort of we know that we can achieve a return of 15.5 for 30.12. So if we look at where 30.12 is and 15.5 is, we can sort of draw our minimum variance frontier. We know that from this point forward is the efficient part of our frontier. So let's, before we go on, let's do one more thing, because we're going to have to combine this with a risk-free asset. So we would like some expression for the return and the variance of a portfolio without concern to the weights, because every point along this line, the weights change. So can we express this line without actually calculating the weights each time? And we can. The return on the risky portfolio is the weighting on the first asset times the return on the first asset plus 1 minus WA. If WA is the weighting on the first asset, 1 minus WA is the weighting on the second times 0.15. And we can solve and simplify. We'll get 0.05 WA plus 0.15. So whatever weighting we have, we can go directly right to the solution. So if it were 100%, if WA were 100%, this would be 0.05 times 1 plus 0.15 would be 0.2. There it is right there, 0.2. And we could do the same thing for the variance of the risky portfolio, which is just the weighting on the first asset squared times the standard deviation of the first asset plus the weighting on the weighting on the second asset squared times the standard deviation squared. We can expand the terms under here. We'll get 0.25 WA squared plus 0.1089 1 minus 2 WA plus WA squared, of course all in the root, and that will give us 0.3589 WA squared minus 0.2178 WA plus 0.1089. Now you may think, what is all that? Well, I'm doing it now. We would have had to do it later on. I'm doing it now just so that we can have an expression at any point on this line. At any point on this line, all we have to do is put the weighting in for WA into these, and we can solve directly. We don't have to go through this whole process every time. We could just solve directly. Okay, so here we are with our same two assets. Correlation is still 0. Here is the efficient. Well, this is the efficient part of the minimum variance frontier, and here's our whole minimum variance frontier that we've drawn out. That's where we left off. That's where we were able to get to. Now we're going to introduce a risk-free asset that has a risk-free rate of 3% and, of course, 0 variance because it's risk-free. So the capital allocation line looks like what? Well, that's easy enough. Believe it or not, all we have to do is take our point. And notice, I like this program. See these two little dots over here? In case you're thinking of using it, this is Sketchbook. In case you're thinking of using it, these little two dots are anchors. So I can anchor this at 3%, and then I'm free to rotate this around, and notice the 3% stays anchored. So I can find a tangent to our line over here without having to adjust each point, and I can simply draw the capital allocation line right through it. So there is our risk-free rate. Here's our capital allocation line. So that's easy enough to do. you could just go right to a graph and say, well, the capital allocation point will be the line with the steepest slope that is just tangent to the efficient part of the minimum variance frontier, and I've done that. Great, but it's not much value unless I know what the slope of this. I'd like the equation of this line. Well, we've already found the equation of the line. We've already introduced it earlier. The intercept is the risk-free rate. And then you have sorry, this is a plus. And then you have the slope of the line. And what is this up at the top here? This is just the return on the risky portfolio minus the risk-free rate. In other words, it's the excess return divided by the standard deviation of the risky portfolio. So this is just a risk-adjusted return times the portfolio standard deviation of the portfolio. So we're just expressing the return on the portfolio as a function of the amount of risk that we're willing to take on. Well, we want to know what this term is so that we have an equation for this line. What is the slope of this line? Well, it turns out that we can figure it out. What is the risk-free rate? 0.03. Plus, what is the expected return on the risky portfolio? Well, we don't know what it is. We don't know what the return is, because without knowing the slope of this line, we don't know how to calculate that. We don't know what that point is. We don't know what the weightings are. But remember, on the last screen I said, let's write out a formula or a solution for the return on the risky portfolio that is independent of the weights. And we did it in terms of WA. So we know that the return on the portfolio, if you go back to the last screen, was 0.05 WA plus 0.15, minus, of course, the risk-free rate. And we'll divide that by the standard deviation of the risky portfolio, and we figured that to be 0.3589 WA squared minus 0.2178 WA plus 0.1089, and all of this, of course, is multiplied by the standard deviation of the portfolio. Well, the 0.3 can easily come out of this. We know what the numerator can easily become. But what we can do, there's no point in simplifying at all this point. All we have to do is this is what we want. We need to know the slope of this line. That's what we want to find out, the slope of this line. Well, we can let y, which is the slope, let y equal this term. Find the first derivative of that term with respect to WA. So we're going to find dy with respect to WA and set it equal to 0. So all you're doing is just going to take a first derivative, simplify it and take a first derivative and set it equal to 0, and you will get WA equal to 38.2%. Now we're in a position to solve, because we know the weighting on asset A will be 38.2%. So the equation for this line, the expected return on the portfolio, will equal the risk-free rate plus some slope multiplied by the standard deviation. If you put 38.2 in, you will get, as our weighting, if we go back up here and put 38.2 in, this will solve out to 0.4978 times portfolio. So the slope of the line is 0.4978. So we can determine what this point is, and we could determine what the return is and risk is at any point along here, depending on how we want to weight the two assets. So let us go ahead and do that now. And here I've got everything we've done so far. Here's our capital allocation line. Here's our minimum variance frontier. Here's the equation for the capital allocation line that we've already determined. What is the risk of the portfolio, the standard deviation of the portfolio, if we're trying to achieve a 20% return? Well, if we're trying to achieve a 20% return, we'll just put 20 here, and we can solve for the risk of the portfolio here. That's easy enough. So 0.20 equals 0.03 plus 0.4978 times the risk of the portfolio. All you do is just simplify and solve. The risk of the portfolio will be 34.2%. 34.2%. So at every point of return, we can calculate what our risk happens to be. Now that is 34.2% versus 50% for asset A, or 33% for asset B. Remember, here is asset A, here is asset B. If they were perfectly correlated, we could draw a straight line, but they have zero correlation, so we get this minimum variance frontier. We have 34.2%, which is higher than B, slightly higher than B, but significantly less than A. So the combination of the two with the risk-free asset allows us to achieve a return equal to asset A, for much less significant risk, 34.2. So let's have a look at some different returns. If we were trying to get a 3% return, what would the risk of the portfolio be? Well, 3% is the risk-free rate, so the risk would be 0. If we were trying to get 9%, you put 0.09 here and you solve, you'll find that it is 12.1. If you put 0.15 in here and you solve for the standard deviation of the portfolio, you'll get 24.1, and finally 20% we know is 34.2. Well, there we go. Great. Now let's put an investor in. We've sat down with an investor, we've talked to them, we've determined their risk profile, and we decide that their A, which is their risk tolerance variable, is 2.5 in this utility function. They have an A equal to 2.5. So let's determine what the utility is for each of these returns. So at 3% with 0, this will be 0 at the end. The expected return will be 3%. So it'll be 0.03. Then we just substitute in at 9%, 0.09 minus 1/2, 2.5 times 12.1 will give us 0.0717. So we see they derive higher utility immediately from the 9% return, the combination of the risk-free and the risky asset that returns 9%, than they do with just the risk-free asset. Well, let's see if we can move them up even higher. Let's reach for the 15% return, minus 1/2, 2.5 times 24, gives us 0.0774. So we've done even better. Let's walk them up to 20%, and let's see how we do there. So we plug in all the variables here, we'll get 0.0546. They drop. So we've identified the optimal risky portfolio. We've drawn a linear combination of the risk-free asset and the risky portfolio. We've looked at an individual, determined it's like I'm investing for my dog. They have a risk tolerance variable, the A variable, 2.5, which says that this is where they maximize their utility at 15%. So let's get our ruler out, and we'll connect 15%, and we'll move this till we get it flat. We can draw a line across to here, and we can put our risk profile in. There we go. So there's the point on the capital allocation line that we would place this particular investor. And this is their indifference curve. So they would be aiming for a 15% return. It looks like they're holding some combination of the risky portfolio, the optimal risky portfolio, and the risk-free asset. They're weighted more towards the risky portfolio, but they didn't like that weighting up there when they were 100% in the risky portfolio. So we added the risk-free asset to bring their risk down. It brought the return down, but in bringing their risk down, we noticed that we were able to increase their utility. That's where that investor belongs. So that's a very extended example of how you would do this. Number one, the first thing we did was we constructed the risky portfolio. We drew out the minimum variance frontier. We added the risk-free asset to determine where it was tangent. From there, we solved for the slope of the capital allocation line to get an equation for it. Then we placed different return levels in to determine what the standard deviation of the portfolio would be at each of those return levels, and combined it with an individual investor to determine what their indifference curve is and where it was tangent on the capital allocation line. Can you explain all of that? I think you should be able to at this point. Now, we haven't gone too far into the math of all of this. That's the next reading. We go heavier into that, and we identify exactly what we mean by this portfolio of risky assets. We get very specific about what it is, and then we ask ourselves, is there such a thing as one optimal risky portfolio for everyone? That we can simply just say everyone gets some combination of that and the risk-free rate? Is that really as simple as it is? And if it was, wouldn't there just be big, fat, concentrated positions in the market? Well, that's what we get to in the next reading. Lots of questions in your mind to answer, right? So before we head into the next reading, I've had a few questions sent to me that I've answered, but I thought that were important enough that I should answer for everybody. And I put them in an order such that by the time we answer the last question, there are 4 questions, by the time we answer the last question, we'll understand the next reading, the motivation for the next reading, a lot better. We'll see exactly where we're headed. And sometimes knowing where we're going helps make what we find when we get there far more understandable. So let's go ahead and answer some of these questions. Question number 1, what about short selling? We've been saying that the return on the portfolio is a linear combination of the weighted average returns of each of the individual assets. Well, what if you short something? How do you weight that? Well, let's take 3 assets, A, B, C. We have expected return of 12%, expected return of 20%, and here we have an expected return of negative 40%. These are expectations, a negative 40%. So we don't want to be long that stock. We don't want to avoid it. We're traders. Hey, look, there's a short. Let's short that thing. So we're going to put 10,000 behind A. We're going to put 25,000 behind B, and we're going to short sell asset C by 20,000. So you're going to invest 35,000 at least to buy A and B, and then you're going to short sell C, which you don't need money for. You need a margin, 130% of the proceeds, but the proceeds act as 100%. The other 2 assets will act as collateral against the margin. If not, you'd probably have to come up with another 6,000 to cover off the margin. You'd be in for 41. That's how it works in the real world, but we're just going to ignore that for the sake of the model. What we're going to say is that we will equate short selling, and this is typically how it's done. Short selling is equated the same as borrowing. In other words, we're just going to borrow 20,000 to finance this purchase. So really, our net in is 15. We're 10 plus 25 minus 20. Our total dollar value is 15,000. So we would weight each of these by their percentage of the 15. So the first weighting is 10 over 15, because it's 10,000, times the return, 0.12, plus the next one is 25 over 15. We can see there's leverage here now, times 0.2, which is return on the second, plus here we have a negative weighting, negative 20 over 15 times its return, which is negative 40. And since we're short a negative return, a negative times a negative is a positive. That would imply that we would make money on this particular case. So the only thing we have to make sure is our weightings add up to 1. 10 plus 15 minus 20 over 15 is 15 over 15 is 1. So our weightings add up to 1. So we can treat short selling just like we would treat borrowing and put a negative weight on that particular asset. Great. How do you find the weightings, W1 and W2, in the global minimum variance portfolio? So remember how we talked. We had 2 assets, A and B, that are less than perfectly correlated, and we'll make A and B here, and we'll make this a 0.5. We'll correlate it by 0.5. How's that? So what would happen is, as we move away from A towards B, if they were perfectly correlated, it'd be a straight line. But we should get something that looks like this. And there'll be some point where we achieve minimum variance. Well, how do you find the weighting of A and B on that? Well, here's how we find the variance of the portfolio. There's our first term variance, our second term variance, plus the covariance term in a 2-asset portfolio. Well, if we express the second weighting as a function of the first weighting. If the first weighting is W1, the second weighting must be 1 minus W1. So let's first go through and replace W2 by 1 minus W1 in both places, and let's expand out. 1 minus W1 squared is this whole term. And then, of course, we're going to multiply it by the term outside the bracket all the way through, which is what we do in the next line here. So if you put in 1 minus W1, expand it, the term out, you'll get this final equation over here. And I'll underline it for you. You'll get this. Great. And I think that's easy to see how we got there. Everything is expressed as a W1. Now we're going to take the first derivative of our function, the first derivative, with respect to W1. So here's the first, I won't go through all the terms, but here's the first term. So the first derivative, since it's W1 squared, becomes 2W1 times the variance of asset 1. Plus, well, this is a constant, so we know that drops out of a derivative. This is minus 2W1 times the variance of 2. Well, the W drops out because we can imagine it to the power of 1. I don't want to teach calculus here, but I'm just helping you out. So that would be minus 2 times the variance of 2. Here we have a square, 2W1, the variance of 2, and on. And in here, we'll just we'll differentiate this first. We'll end up with 2 minus 4W1. Then we'll expand it with the term outside, 2 times this minus 4 times that. You'll notice that term appears both. So once we have the derivative, this is what the first derivative of that function will look like. So here we are here. This was the first derivative. And if we're trying to find any minimum or maximum points, we know that we set the first derivative equal to 0 and solve for W1. So if this is the first derivative all along here, let me just underline it. And remember, we went down here because I did one extra step in here to solve inside the bracket before I expanded. Set this equal to 0 and solve for W1. Well, we just set this equal to 0, and then we just collect terms. I'm not going to go through that whole process of collecting terms. You know how to do that. And we just isolate W1 to one side, and we'll get this. Now all we have to do is take our terms and plug them into here. So our variance 2 squared, we see variance 2 is over here, 0.06. So you'd put 0.06 in squared, minus, you just put in the terms and solve, and you'll get 59.07%, 0.5907. So the weighting on W1 would be 0.5907, and 1 minus W1 would be 1 minus 0.5907, or 40.93. So if we weight asset A by 0.5907 and B by the difference, we would arrive at the minimum, the global minimum variance portfolio for these two assets. Now, here's the thing, and here's why we have to be very careful about finding a global minimum variance portfolio and saying, aha, that's it. That's only it. That's only it if two things happen. Number one, the correlation between A and B remains at 0.5. If the correlation moves, let's say it goes to 0.55, let's say there's a bit of turmoil in the market, and whenever there's turmoil, correlations start moving towards 1. Let's say the correlations go from 0.5 to 0.6. This will no longer be the global minimum variance portfolio. Those weightings will be wrong. You'll have to readjust. You'll have to reweight those two assets. So the correlation must stay solid at 0.5, and volatility does not change. If volatility changes on either one of these, either A or B, or for the market as a whole, that correlation is going to change. Volatility will change the variance, and that correlation will change. The next question actually is a very good question. Are any stocks negatively correlated with any others? And when we talked about the risky portfolio, or the portfolio of risky assets only, that's that efficient frontier, or the minimum variance frontier. There's our global minimum. There's the efficient part. We were saying that if we can find stocks that have very low correlation with each other, we can move this way on our total portfolio variance until we get to negatively correlated assets, which will push it even more. But if this is the frontier of portfolios of risky assets, is it possible to find stocks that are negatively correlated with other stocks? Because at some point, what we're going to do is we're going to allow the market portfolio of assets of stocks to stand in for the risky portfolio. In other words, we're going to use an equity index. Can you find negatively correlated stocks? Typically, no, because they all have a common factor, which is the market risk associated with them. So they're all correlated by the degree of systematic risk that they all possess. Now, we're jumping ahead a bit, but that's important. We're jumping ahead, but that's okay. We're setting the stage for the next reading. This actually leads us nicely into a discussion of systematic versus non-systematic risk. So, it is rare that you're going to find negatively correlated stocks. However, a short sale can easily solve that problem. So you can find if two stocks are not negatively correlated, if you short one and you're long the other, you have negative correlation automatically. You can engineer negative correlation if you cannot find negative correlation. Last question. Won't the variance of the portfolio become difficult as N increases? We see in a two asset portfolio, we have two variance terms and a covariance term. In a three asset portfolio, we would have three variance terms and three covariance terms. So if n equals 50, we would have 50 variance terms and 1,225 covariance terms. And we figured out covariance by n squared minus n over 2. Are we really going to start doing this? And if we're trying to find the minimum variance portfolio of all risky assets, there are literally thousands of assets out there. Isn't that just a ridiculous requirement? Who's going to do that? Other than the largest banks that have the horsepower and the programming power and the computing power to go through those on a daily basis to determine what to add and what to take out, is that a rational expectation for anybody? No, it's not. Actually, no, it's not. Which is why the next reading will help us solve this problem, because of this simply just can't be an efficient way to go forward. We need a better way. So rather than comparing securities with each other, we are now going to move towards comparing them with a benchmark. So if we have asset A and asset B, we will compare it with some benchmark. That benchmark, we'll find out, is beta. So now, if we're looking at, if our N is 50, we only need 50 betas. Rather than 50 variances and 1,225 covariances, we only need 50 betas because we have a benchmark. That basically is the heart of the next reading.